Money doesn't just live in your wallet anymore. These days, it comes in all shapes and sizes, from contactless cards to crypto and stablecoins. But not all digital money works the same way. While cryptocurrencies aim to be open, borderless, and decentralized, a very different model is emerging: Central Bank Digital Currencies, or CBDCs. Backed by governments and designed for control and stability, CBDCs represent a shift in how money could work and who gets to design the rules. This new approach to money has its advantages, but not everyone's on board. In some parts of the world, policymakers are now proposing laws to restrict how CBDCs might be issued. So where's the line between innovation and overreach? Let's unpack what a CBDC is, what it's not, and if the pushback is justified. Welcome back to the Binance Studios, and if you're new here, don't forget to subscribe. First, what is CBDC? CBDC stands for Central Bank Digital Currency. It's a digital version of a national currency, like a digital euro or yen, issued directly by the central bank. And unlike cryptocurrencies, CBDCs are centralized, state-controlled, and designed to maintain a stable value because they're pegged one-to-one to the country's official fiat currency. And unlike stablecoins, which are created by private companies and backed by reserves, CBDCs are public instruments backed by law and government oversight. This isn't a new form of money. It's a new infrastructure and one that changes the dynamics of control. There are many reasons that central banks are developing CBDCs. Cash use is declining and digital payments are rising, but many of those payments rely on private systems like commercial banks or payment apps, and governments want to stay involved in how people spend, save, and transfer value. CBDCs are a way for them to do just that. Beyond being fast and efficient, they can improve financial inclusion, particularly in areas where people have mobile phones but limited access to traditional bank accounts. They could also reduce the cost of international transfers, support real-time settlements, and even allow for programmable features like subsidies that expire or payments tied to specific goods. But CBDCs aren't just about efficiency and innovation. They're also about control. As crypto and stablecoins grow, many policymakers see CBDC as a way to reassert state influence over digital money. And that's part of the appeal, but also part of the controversy. Because depending on who is in control, CBDCs could be used to track spending or limit financial privacy. Some see them as a tool for stability and inclusion, but others see the potential for overreach. At first glance, CBDCs might sound a lot like stablecoins or even crypto, but while all exist in digital form, they're built on very different principles. Cryptocurrencies like Bitcoin are decentralized, borderless, and not controlled by any single entity. Stablecoins like USDT or USDC are issued by private companies. They aim to stay pegged to fiat, but rely on the transparency and quality of reserve management. CBDCs are fully centralized. They're created and managed by central banks, and they're designed to function like cash, but without the anonymity, freedom, or censorship resistance that crypto offers. In short, crypto stands for the freedom of money, and CBDCs aim for convenience and stability, but with that comes oversight, programmability, and potential limits on how and where money flows. Now, you might be wondering how CBDCs would actually be created and how they would work in practice, but they're not mined like crypto. They could be created the same way cash is, but just in digital form. So instead of printing banknotes, the central bank would issue digital currency directly onto its own balance sheet. Users would then interact with it through commercial banks or digital wallets the same way that you might use a mobile banking app today. Some CBDC designs could also explore programmable features like limits on how funds are used or expiration dates on balances. Think of it as money with built-in rules. And that means, in theory, a government could control how you spend it. Not necessarily for negative reasons. It could simply be to ensure funds are used for specific purposes. For example, a subsidy that could only be spent on groceries or a relief payment that must be used within a certain time frame. These features represent a fundamental shift from cryptocurrencies, which are built on the principle of financial freedom, where users can store, send, and spend without central permission or imposed conditions. In some jurisdictions, proposed legislation is aiming to restrict the implementation of CBDCs. The anti-CBDC bill reflects growing concerns over privacy, government surveillance, and potential misuse of monetary control. The idea is simple. If digital money is issued by the states, it should still function like cash, meaning it should still be open, private, and permissionless. And many CBDC designs don't yet guarantee those qualities, and critics could argue that programmable traceable money could be used to restrict spending, enforce policy compliance, or even freeze funds. And this is part of an increasingly global debate about the future of money. CBDCs may introduce new risks around surveillance, pressure on banks, or digital exclusion for users. And what matters most isn't just how CBDCs work, but who they work for and what values they uphold. Thanks for watching, and as always, stay informed. And if you want to learn more about anything related to crypto, you can check out the Binance Academy free readings that we've left some resource links in the description below. See you in the next one.